Hi everyone and welcome to the London session update with myself, Kathleen Brooks, for Wednesday the 26th of June 2013. Well, it's been a really volatile day on the markets. We've had stock markets bounce higher, we've had the dollar move higher, interestingly enough as well, and US Treasury yields have fallen. Now, why has the dollar actually risen on the back of falling bond yields? Well, it's because the dollar has a very mixed relationship at the moment. Last week, as stocks were tumbling, we saw the dollar moving higher with Treasury yields, but it can be capricious, the old greenback, because after the better than expected US economic it's moved higher with stocks. Now, the interesting thing that we've had earlier today was some US GDP data. The final revision actually revised growth down by quite a sharp amount. The Q1 annualized rate of growth in the US fell from 2.4% down to 1.8%, largely because of a fall in personal consumption. So personal spending, largest part of the US economy, not looking fantastic. So we saw a bit of a wobble, but overall I think the markets are taking that news about the Q1 GDP in its stride, really, because it's backward-looking data. It doesn't really change anything. It certainly doesn't change the prospect of more Fed tapering, but I think one of the reasons why the dollar is rising is that yes, there is tapering and the likelihood of tapering going on, but then on the other hand, you also have the fact that the data is strengthening. So the dollar's getting the best of both worlds. Now this has really helped its performance against the euro. This is euro dollar in front of you, and as you can see, it's been very weak, and we got a very bearish development earlier when it fell through a cluster of moving average support between 130.70 to 130.80. That is now key resistance. Now below here, where could we go? Well, the 129.95 is the top of the daily Ichimoku cloud. Now those of you who follow clouds will know that if you get below the top of the daily Ichimoku cloud, it negates the uptrend. So that would suggest further losses. So we really are watching out for that. We do think that 129.90 to 130.10 area, it will be sticky support, but the fact is there isn't too much protecting the euro at the moment. It did fall on the back of some ECB comments from Draghi as well, that the bank stands ready to act and they will not be tightening monetary policy anytime soon. Remember, that does look a little bit in contrast now to what the Fed is doing with all of their tapering talks. That is euro negative, and we could see a retest of that 130 level in the next couple of days. Now the other chart, or the other asset class that has been going crazy in the last couple of days has been gold. It's had a huge amount of volatility. Let's take a look at it there. Gold doesn't seem to be able to rally. Certainly doesn't seem to be able to sustain early rallies. Now, we saw another huge lurch lower overnight during Asia and into the European Open today. Basically, the driver, stronger US economic data, it makes tapering more likely. Added to that, a very benign inflation environment. Now, gold did manage to find a bit of support at 12.20. Remember, it wasn't that long ago that we were looking at 13.20. Just a couple of days, in fact. So we are at that 12.20 level. Now, it did bounce back higher, actually, gold did, on the back of that weaker US GDP print for the first quarter. However, we think that any rallies will be sold into. And what we may see is a return to the double bottom low from July 2010 when gold was at 11.70. So we're going to be looking at that to see if that can act as some good support. But right now, gold does look very vulnerable. And there could be some selling interest, 12.50 and then 12.75. Okay, everyone, good luck trading for the rest of the day and join us soon for some more. Thank you.